On November 16, 2020, Tesla was announced to be included in the S&P 500. As soon as the news broke, Tesla shares rose 13% in after-hours trading, soaring to $461.47. The S&P 500 is a stock price index created by Standard & Poor's among the world's top 3 credit rating agencies. It's a stock price index of 500 US blue chip companies, and it's very difficult to be selected for these 500 companies. It must be a US-based company, have a fourth quarter operating profit in a row, including the previous quarter, and a market capitalization of more than $8.2 billion. Tesla has passed all these conditions. Unlike other companies that have been included in the S&P 500, Tesla has an unusual record. First, Tesla's inclusion in the S&P 500 is the largest ever. Second, after most companies announced their inclusion, there were only 5 to 10 days of gaps, but Tesla has 5 weeks. So why Tesla's inclusion in the S&P 500 good for investors? If included in the S&P 500, other index fund investment companies that follow the S&P 500 will buy Tesla shares mechanically. Then, the stock will have to go further. S&P Dow Jones Indices says Tesla's inclusion in the S&P 500 would account for about 1% of the total. The fund following the S&P 500 was about $4.4 trillion, and then about $44 billion, or 1% of this money, goes into Tesla. On the other hand, is there any reason for the decline in stock prices? Since Tesla announced in July that it had posted operating profit margins for the fourth consecutive quarter, many have expected to be included in the S&P 500. Tesla's current share price may already reflect that expectation, and the increase in investment funds means more money could be betting on a decline. Therefore, you need to be careful about short-selling investments. Tesla is scheduled to be included in the S&P 500 on December 21st, and the last trading date before that day is December 18th, which means most index fund investment companies will include Tesla shares in their funds as much as they planned before December 18th. Generally, if a stock is included in the S&P 500, the trading volume is the highest on the day, right before the inclusion date. What about the other companies that were included in the S&P 500 in the past? Amazon in 2005, Google 2006. The two companies returned to their share price in about a month before they were included. Facebook, which was included in 2013, returned to stock prices before being included in the 4 days. Twitter, included in 2018, took only 2 days to return to the previous share price. So, When a share is included in the S&P 500, will it always rise above the share's price on the day of the announcement? We must be careful at this time. There are companies whose stock prices have fallen since they were included, even after the announcement. The following companies are examples of that. Let's take a look at Dexcom, which announced on May 6, 2020, that it will be included in the S&P 500. It was included on May 12, 2020, about a week later. Shortly after the inclusion announcement, stock prices rose 10.32%. But the day it was included was when the stock price fell, and it was included at 12% higher than the announcement. And the current stock price is 348 point. And the return rate is negative compared to the time it was included. We are going to see a company called Etsy that was included in the S&P 500 after beating Tesla last time. It was announced on September 8th and included on September 21st, and stock prices have risen little since the inclusion, approximately 2% increase. At the time of the inclusion, it was included with a 5% increase, and the stock actually exploded after it was included. It went up to 155 points, but now it's down a little. So it's up to 140 points, about 26.7% from the time it was included. Stock prices often rise from the announcement of inclusion in the S&P 500 to the actual inclusion. However, the degree of increase varies widely from company to company. Some companies go up right after they are included, and others go down. Benefits of S&P 500 included. First of all, the inclusion of the S&P 500 has a favorable effect on corporate creditworthiness. Second, the demand for index funds make it possible to secure stable demand. In addition, the fact that it is included in the S&P 500 improves public awareness. Negative impact of S&P 500 included. Number 1. Due to the increase in passive stockholders, stock liquidity is likely to become heavier than necessary. Number 2. It is easy for a company to be negligent in its activities to increase its value. Number 3. Passive shareholders are not interested in the corporate value of the company, which means that stock prices are likely not to represent corporate value. Now, here's the conclusion. The return on stocks included in S&P 500 has been significantly lower over the last decade. This is because investors now know that the inclusion of the S&P 500 no longer has a strong long-term impact on stock price hikes due to the market learning effect accumulated for investors. So, if you look at the companies that have recently been included in the S&P 500, although there have been some factors of stock price increase, the upward trend hasn't been long. Thus, Tesla's long-term future corporate value is the most important item to consider in its stock investment.